Today's Ask Spencer is a really enjoyable conversation to have with real estate investors where we get to discuss returns on investment. Today's question comes from an old high school buddy. What's the target ROI on the cash in investment for the rental properties you're looking at? Down payment, closing and prep costs, etc. I'm focused on 3 different types of investing in real estate, and I'll go over each: house hacking, buy and holding, and flipping. We'll first cover house hacking, which is where you buy a house and rent out the rooms to roommates. The fun part about investing is that there's inherent risk. You're playing a game where money can be gained or money can be lost. And at some point, you have to determine if putting money into a property is worth the return that's expected. And sometimes you have to put money into a property where the return is a little undetermined. Here's the outside of my house hack currently. It is not the prettiest property, and when you look at it, you go, there's no way I'd buy that. As an investor, you have to see what others don't, especially the hidden gems, and that's exactly what this is. On $2,000 a month expenses, I'm bringing in $3,600. $1,600 a month cash flow with me living in the property is absolutely great returns. Something that a lot of people would not have noticed had they driven past this property. Now with a house hack, you get much higher returns than a traditional investment. You have to live with the tenants, and additionally you get residential financing, which are much better terms for you, the investor. Sometimes if you only have a little bit down, that's fine, because you can get in a house with a really low down payment and still get the benefits of owning property. Additionally, you experience economies of scale with each additional bedroom. If you think about it, each house is going to have one roof, one HVAC unit, one water heater. In Vegas right now, the average home price is somewhere around $300,000. So if you think about it, you can get a 3-bed house for $300,000, or you can go a couple streets over and get a $300,000 house with 5 bedrooms. And if you think about it, you have the same expenses every single month and the same repairs and the same big maintenance items over time. But if you get an extra 2 bedrooms, that could be an additional $1,000 to $1,200 a month in income. So to answer your question regarding a house hack, I actually don't look at the exact return. What I focus on mostly is making sure all of my expenses are covered each month and that I have a surplus left over for cash flow. The value or return of a house hack is not having living expenses, and that extra little cash flow can be used towards investing in more property. There are 4 different types of returns with buy and holding investing. This is where you buy a property and hold it and rent out the property to other tenants. You have your cash on cash return, which is just simply how much cash is left over after all of your expenses and mortgage and taxes are paid. Second, we have appreciation. Now this is not guaranteed, nor should you buy a place strictly for appreciation unless that is strictly your business model. But over time, there are a lot of studies that show that real estate will go up and appreciate over time. Third, you have your loan paydown. Every single month, the tenants are paying down your mortgage, and you keep a little bit of that principal in equity. And fourth, you have a depreciation write-off. You get to depreciate the property over 27.5 years. So those are the 4 ways that you could consider a return on a buy and hold property. For me specifically, I actually don't have any interest in putting down 25% on a buy and hold property. I just don't have interest in saving up a lot of money. The multifamily market here in Vegas has taken off, and a lot of the properties are between $300,000 to $350,000. And number one, I just don't have $75,000 to $80,000 for a down payment. And number 2, I just don't want to put in $75,000 to $80,000 into a property and make 5%. That's too low for me. So what I look for is creative financing. I want to get into a property with some type of seller financing where I can bring a little bit of money to the table and I get an outsized return. And I did just that with my fourplex. I'll be making a few videos on the fourplex and how I use seller financing and creative financing, which is really important for you because if you're a beginner, you may not have all that money to invest in properties, and this might be the best strategy for you. So go ahead and hit subscribe. Keep an eye out for those videos because they'll be really helpful. Now, if I do have interest in buying and holding in the future, it's going to be because I have a lot of cash saved up and I don't want it to sit in a bank. So instead of it sitting in a bank, or maybe if I want to lower my risk profile a little bit, I might consider putting some money into maybe a small multifamily, a small apartment complex. And since I have experience with D-class neighborhoods, I'm thinking I'm going to put money into maybe a B-class or better, a nice stable neighborhood in a really good area that has a good chance of appreciation. Now, would I put down 25%? Maybe, maybe not. It'll be determined. But what is consistent is I want to find deals and deals that have some type of creative financing. It's hard to say exactly what type of return I'd be looking for. I generally look for 8 to 10% if I were to put a large down payment into a property. However, if I can get into a property with very low down payment, then the returns aren't going to be as good. But because I have a low down payment, the other factors of return can come into play, that being appreciation, loan pay down, and depreciation write-off. Now on to the fun part of real estate investing, flipping properties. With my first flip, I focused mostly on just completing one flip. I didn't go in with the expectation of any type of profit. I was looking at maybe 15 to 20 grand when I underwrote the deal, but I focused mostly on just making a profit. And when the appraisal came in, I was actually expected to make 20 to 25 grand of profit, and I figured that was a pretty good deal. 1 month into the first flip, I was actually presented with another flip, and this one, the numbers were pretty good. And similarly to number one, I didn't care so much about the return or any type of profit. I just wanted to exit a second flip because I knew the value of it. I had a contractor lined up, it was a good market, and I knew it would sell. So when I went into this one, obviously there was some profit expected of 15 to 20 grand, just like the first one, but I didn't care about the exact returns. Hard money lenders really care about how many deals you've exited in the past year or two, and that's more important to me as a beginner than it is getting some type of return. So I really focused on trying to exit 2 loans as quickly as I could. So the real return to me is the future much better terms and rates that I'll receive on flipping, because this is the avenue I want to take. Moving forward, I'm going to focus mostly on how much time it takes to exit a loan to determine how much profit I want to make. Now, if it's in a really good neighborhood where I know the property will sell pretty quickly, I'm pretty comfortable in the 15 to 20K range. If I'm buying in a neighborhood that the houses don't sell as quickly, or maybe it's a large project and there's more room for risk, then I'm probably going to be looking in the 22 to 28 range of profit expected. Side note, I'm actually in the process of getting my license right now because I want to be the one making the 3% on the back end, which will help take away some of the risk. Now that I've told you the expected profit, let's look at the actual return. Most hard money lenders I've seen, once you've exited a couple loans, will loan out 90% of the purchase price, and they'll loan out 100% of the rehab, typically up until 70 to 75% of the ARV. So I'll give you a quick example. Let's say a house in the Midwest is $100,000 and needs $50,000 of work. And when it's all said and done, you're looking at a $200,000 purchase price. For that property, we're going to need $10,000 for the purchase of the house. $140K will be the loan amount, so the amount of points will be about $1,400 to $2,800. Expect $1,500 in fees and $500 for the appraisal. Using simple numbers, we'll need $15,000 cash at close to buy this property. I've mentioned the profit being anywhere between $15,000 and maybe $30,000, so if we're all in at $15,000, the expected return will be 100% to 200%. Now, why can flipping provide such high returns? Risk. Thank you so much for watching. Most importantly, I hope you got something out of it, as I hope it was entertaining and educational. Make sure to hit the like button if you enjoyed it, and please leave a comment if you have any questions for me, because I can use it for a future Ask Spencer episode. Make sure to hit the subscribe button if you want to follow along on my journey from $0 to financial independence, where I share every step of the way with you. And most importantly, I'm going to share with you exactly how you'll be able to do just the same.